They want you to feel relief right now. That is the plan. After watching silver move from $29 to over $83 an ounce in the span of 12 months, a move that shocked even the most bullish analysts and left the institutional short sellers scrambling, they need you to feel like the storm has passed, like the danger is behind you, like the smart thing to do right now is exhale, maybe even sell, maybe sit on the sidelines and wait for things to settle down. Do not do that. Because what I'm going to walk you through today is not a story about a bull market taking a breather. It is a story about a system that is breaking apart at the seams while the people who built it are using every tool in their playbook to keep you from seeing what is actually happening, including this dip, including this correction, including this window of calm, to distract you from a series of structural events unfolding right now that have no historical precedent in the modern silver market, culminating in a regulatory and delivery landscape that changes permanently on February 27, 2026. And once you understand the full picture, not the headline, not the price chart, but the mechanics underneath, you will understand that what we are living through is not a cycle. It is a transition, and transitions do not give you a second chance to act at the prices you see today. Let me start exactly where I always start, the money. Because before we can talk about silver, before we can talk about Comex or the LBMA or Basel III or delivery crises, we have to be honest about what the dollar has become and what that means for everything priced in it. The US dollar has lost over 96% of its purchasing power since the Federal Reserve was created in 1913. That is not a theory. That is Federal Reserve data measured against the Consumer Price Index across every U.S. city average. $100 in 1913 is worth less than $3.50 today in real purchasing power. The dollar your grandparents saved, the dollar your parents were told to keep in a savings account, the dollar the government tells you is stable. It has been quietly, systematically, relentlessly destroyed, and the mechanism that destroyed it is the same mechanism that is now hitting its mathematical limits, because you cannot debase a currency indefinitely without the people and institutions holding that currency eventually choosing something else, something real, something that cannot be printed. That is the context. Everything else flows from that. Because when you understand that the dollar is a managed decline, not a collapse, a managed, engineered, deliberate decline, then you understand why the official price of silver, a price set by paper contracts traded in New York and London by institutions with concentrated short positions, cannot possibly represent the true value of a metal that you cannot create out of nothing, that nature took hundreds of millions of years to deposit in the earth, and that the modern industrial economy has decided it cannot function without. Silver has been money for 6,000 years. It was money when empires rose and fell. It was money in the U.S. Constitution. Article 1 explicitly states that only gold and silver coin shall be legal tender in payment of debts. The Coinage Act of 1792 defined the U.S. dollar in terms of silver. That we abandoned silver as money, not because it failed as money, but because fiat currency is more convenient for governments that want to spend beyond their means without asking permission. And now, as that fiat system strains under its own weight, with U.S. national debt exceeding $36 trillion, with M2 money supply having expanded by over $6 trillion in a single year during the pandemic, with the dollar index having fallen 9.5% in 2025 alone, its worst annual performance since 2017, real money is reasserting itself. Now, let me be precise about what is happening in the silver market right now, because the data is extraordinary and it deserves to be laid out clearly. The Silver Institute, the industry's own authoritative research body, confirmed that global silver demand hit an all-time record in 2024, 1.21 billion ounces total demand. Industrial fabrication alone consumed 680.5 million ounces, an all-time record. The photovoltaic sector, solar panel manufacturing, accounted for 29% of all industrial silver use in 2024, up from just 11% a decade ago. Global solar capacity is expanding at a compound annual growth rate of 17% through 2030. Every gigawatt of solar capacity requires approximately 0.8 to 1 million ounces of silver for its conductive paste, its bus bars, its cell interconnections. You cannot swap it out. There is no substitute that works at industrial scale for silver's electrical conductivity, and silver is the most electrically conductive element that exists on this planet. Gold comes closest at 62% of silver's conductivity, but it costs 80 times more per ounce, and manufacturers confirm that silver would need to approach $1,000 to $4,000 per ounce before substitution becomes economically viable. We are nowhere near that threshold, which means demand is structurally locked in. Electric vehicles use between 25 and 50 grams of silver each, between 67 and 79% more than a conventional internal combustion vehicle. Every data center powering the artificial intelligence revolution is packed with silver-bearing components, and global IT power capacity expanded 53 times over between 2000 and 20. Medical devices, 5G infrastructure, defense systems, water purification, RFID chips, antimicrobial coatings. Silver is woven into the infrastructure of the modern world in ways that cannot be unwound. And on the supply side, mine production grew just 0.9% in 2024 to 819.7 million ounces. Mexico, the world's largest silver producer, actually saw output decline 4% year over year. And here is the critical structural fact: 72% of the world's silver comes as a byproduct of mining other metals, copper, zinc, lead. You cannot build a silver mine to solve a silver shortage. You would have to mine copper or zinc or lead at a loss, which no company does. New mines that are fully permitted and funded take 5 to 8 years from approval to first production. There is no supply response fast enough to address a crisis that is already here. The Silver Institute documented 5 consecutive years of structural supply deficit. In 2021, silver ran a deficit. In 2022, a deficit. In 2023, a deficit of 200.6 million ounces. In 2024, a deficit of 148.9 million ounces. The cumulative shortfall from 2021 through 2025 reached approximately 800 million ounces, nearly a full year of global mine output consumed, burned through, extracted from above-ground inventories that were already finite. And in 2026, the global silver market is projected to record its 6th consecutive annual deficit, approaching 200 million ounces once again. This is not a temporary imbalance. This is a structural, deepening, compounding drain on a finite resource that the entire modern technological economy depends upon. Now let's talk about the paper market that sets the price you see on your screen, because this is where the fraud is most precisely visible and most critical to understand. The Comex Futures Exchange in New York and the London Bullion Market Association, the LBMA, together constitute the global price discovery mechanism for silver. And the way they work is simple, and it is the same mechanism that eventually breaks every fractional reserve system in history. They issue far more paper claims on silver than there is physical silver to back them. According to testimony given at CFTC public hearings by Jeffrey Christian of CPM Group, the paper-to-physical ratio in silver markets has historically stood at approximately 300 to 1. 300 paper ounces for every single physical ounce of real deliverable silver. That system works precisely as long as nobody actually demands the metal. And that assumption is now failing. Inside Comex, registered silver inventory, the metal specifically set aside and immediately eligible for delivery against futures contracts, has shrunk by approximately 75% since 2020. By early 2026, registered inventory was hovering around 82 million ounces, while total Comex open interest in the March 2026 contract alone had reached between 85,000 and 91,000 contracts, representing a theoretical delivery obligation of between 425 million and 455 million ounces. That means the paper claims against Comex registered silver stood at roughly 5 times the available metal. And that is in a good week. In just 1 week of January 2026, over 33 million ounces were withdrawn from Comex, 26% of registered inventory disappearing within days. February deliveries were already running at 2,700 contracts, 13.8 million ounces with no sign of slowing. Veteran analysts watching this data closely began describing what they saw as the preconditions for what they called, in plain language, the funeral of Comex. If March 2026 sees delivery demands that exceed even 20% of open interest, a conservative estimate based on historical precedent, the exchange cannot physically fulfill those contracts with the metal it has on hand. And we already know what happens when that pressure point is reached because we saw a preview of it on Thanksgiving weekend 2025. On November 28, 2025, as silver futures were approaching historic breakout levels, having gained 84% year over year at that point, a delivery demand for 7,330 Comex silver contracts was submitted. That is 36.5 million ounces of physical silver demanded for delivery in a single event. The total registered, immediately deliverable silver at Comex at that moment was approximately 1.2 million ounces. The demand was 30 times what existed. Within hours, the CME Group's main data center in Aurora, Illinois, suffered what the exchange called a cooling system failure. Trading froze. It was down for 11 hours, halting $26.3 million in daily contracts spanning equities, commodities, treasuries, currencies, and agricultural products. When the system came back online, 13.5 million ounces of JP Morgan's registered silver had vanished from the deliverable list. The 36.5 million ounce delivery demand was quietly rolled to March 2026. Reports indicated that a $65 million cash settlement changed hands off exchange. The CME called it a technical glitch, but a commodity trader with over 20 years of experience described what actually happened in an industry channel. The silver futures book was very thin. Then a trade cleared the offer side with no quotes left. The CME is giving time to market makers to reposition and avoid a price print off the charts. That is not a cooling system failure. That is the market telling you in the clearest possible language that the system cannot deliver what it has promised. And March 2026 is the deadline that promise comes due. 3 times in less than 3 weeks starting December 12, 2025, the CME Group raised margin requirements on silver futures. CME Clearing Advisory 25399 issued December 30, 2025, documented an increase that brought initial margins up by approximately 30% effective December 34, 2025, timed for when market participants were least attentive during the holiday break. Margin hikes force leverage traders to post more collateral or liquidate. They flush out long positions. They protect short sellers. And the largest short position in silver belongs to institutions that have systematically profited from keeping the price of silver below its true physical market value for decades. JP Morgan Chase paid $920 million in settlement with the Department of Justice and the Commodity Futures Trading Commission for years of spoofing the silver and gold futures markets. Spoofing means placing fake orders to create false price signals, then canceling them before execution to manipulate the market in your favor. 8 major banks in total paid $1.27 billion in verified regulatory settlements for silver and gold market manipulation spanning 2008 to 2016. These are not allegations, these are adjudicated facts. In October 2025, London was unable to deliver 1,000 tons of silver that India had requested. The market froze. LBMA Vault Holdings, the world's largest over-the-counter precious metals trading hub, showed a free float of approximately 155 million ounces of physically available silver as of late 2025 against daily trading volume that exceeded that entire free float. Total paper claims on LBMA silver reached 3.86 billion ounces in October 2024, verified in the LBMA's own data, against vault holdings of 851 million ounces. That means the ratio of paper claims to real metal in London alone was 4.5 to 1. Silver lease rates, the cost to borrow physical silver, which in a healthy market runs between 0.3 and 0.5% annually, had exploded to 8 to 9% by January 2026. During the October 2025 crisis, annualized backwardation in silver reached 20%. Backwardation means spot silver commanded a 20% annualized premium over the promise of future delivery. That is the market saying in explicit quantitative terms, we do not trust future promises. We want the metal now, and there is not enough metal now. Shanghai silver inventories fell below 446 tons by October 2025, the lowest since 2016, with over 300 tons drained in October alone. The Shanghai Futures Exchange silver contract was trading at premiums of $3 to $5 per ounce above Comex prices, a geographic spread that signaled regional supply constraints severe enough to distort global pricing. Chinese banks were buying silver cheaply in New York and London and reselling it in Shanghai at a premium, not because of speculation, but because the physical metal was more scarce in Asia than in the West, and the price differential reflected genuine supply pressure. And then, effective January 1st, 2026, China formalized what its market had already been signaling for months. It implemented export licensing controls on silver, elevating it to a strategic material, the same regulatory category as rare earth metals. Only 44 companies received approval to export silver from China to the rest of the world. China accounts for approximately 60 to 70% of global refined silver output, with 44 approved exporters serving the entire planet's needs outside China. The refining pipeline that Western industrial users have depended upon is now operating under a choke point that Beijing controls, and that Beijing will tighten further as its own domestic solar, EV, and technology manufacturing sectors require more metal. Now I want to come to the February 27 date specifically, because this is where the regulatory overlay on top of everything I've described creates a convergence that even the most sophisticated market participants have not fully priced in. Under Basel III, the global banking regulatory framework developed by the Bank for International Settlements after the 2008 financial crisis, now in its final implementation phase, physical allocated silver held by banks qualifies as a Tier 1 asset, equivalent in treatment to cash and government bonds, carrying a 0% risk weighting. That sounds like good news for silver, and in terms of long-term institutional demand for physical metal, it is. But the net stable funding ratio, the NSFR, is where the mechanism that has kept silver artificially suppressed for decades is being forced to unwind. The NSFR requires banks to secure stable funding equal to 85% of their precious metals positions, and is that for unallocated silver, which is the paper silver, the promises, the fractional reserve metal that underpins the entire LBMA and Comex pricing system. The cost of carrying those positions has become prohibitively expensive. The unallocated silver market, which represents the bulk of the 300 to 1 paper to physical leverage in the system, is being made economically untenable by regulation. Banks are being forced to either allocate physical metal to back their positions or exit, and the free float of physical silver that would be needed to back those positions at scale does not exist. The LBMA itself published a letter to the UK's Prudential Regulation Authority warning that Basel III's NSFR requirements could undermine the clearing and settlement regime and potentially cause some banks to exit the system entirely. The World Gold Council co-signed that letter, but in the very institutions that run the paper silver market, write to their regulator and say that the rules required to make the market honest might collapse the market, what they are telling you is that the market is not honest. It never has been. And the gap between the paper price and the physical reality is so extreme that making the system honest would break the pricing mechanism entirely. That is not a bullish opinion about silver. That is the market's own architects admitting in writing to the regulator that the system they operate is structurally incompatible with transparency. February 27, 2026 falls within the window of the March 2026 Comex delivery cycle. First notice day when holders of long positions who intend to take physical delivery must declare their intent. This is the single most important delivery month of the year. The March contract historically sees 18 to 22% physical delivery rates compared to 12 to 15% for other months. With open interest at 85,000 to 91,000 contracts, a historically normal delivery rate would require 23 million ounces of registered silver. An elevated delivery rate, which the evidence overwhelmingly suggests is coming, could require 32 to 38 million ounces. Registered inventory stands near 82 million ounces. But that 82 million includes metal that has already been claimed, metal that is subject to multiple competing obligations, and metal whose custodians, as we saw in November, will not sell at any price. The real deliverable number is far lower. When delivery cannot be satisfied, an exchange has two choices. It can force cash settlement, paying holders the paper price instead of the physical metal, which destroys the credibility of the futures market as a mechanism for owning silver and accelerates the decoupling of paper price from physical price. Or it can change the rules, raise margins again, limit delivery demands, impose position limits, using the same institutional authority the exchange exercised against the Hunt brothers in 1980 when they nearly cornered the silver market, and the same authority the CME exercised in December 2025 when it tripled margin requirements in 3 weeks. But here is the critical difference between 1980 and now. In 1980, when the exchanges broke the Hunt brothers by changing the rules, the silver market was speculative. It was excess financial demand chasing a finite supply. The rule changes worked because they eliminated the speculative demand. Today, the demand for physical silver is not primarily speculative. It is structural industrial demand from solar manufacturers, electric vehicle producers, data center builders, defense contractors, and medical device manufacturers. These buyers do not roll futures contracts. They do not accept cash settlement. They need the physical metal to keep their factories running. No exchange rule change can make a solar panel manufacturer accept a cash payment instead of the silver paste required to print the conductive fingers on a photovoltaic cell. The industrial demand will not disappear when the exchange raises margins. It will go find the physical metal on the open market at whatever price is required to source it. And that price discovery, real physical, unmanipulated price discovery, will happen in the spot market, not the futures market. And when the futures price and the physical price diverge completely, the futures price becomes irrelevant. The paper price dies. The physical price becomes the only price. This is what a monetary transition looks like. Not a sudden dramatic moment when a news anchor announces that silver has gone to $500 an ounce. It looks like this, like what we are living through right now: gradual, systematic, undeniable tightening of physical supply, quiet accumulation by informed institutional players, repeated stress events at delivery deadlines that are managed and suppressed just long enough to prevent panic, increasing divergence between the paper price and the real-world cost of sourcing physical metal, followed by a moment when the management fails and the gap closes violently. The dollar, as we discussed, has already lost 96% of its purchasing power since 1913. Fiat currencies have a perfect historical track record of losing against real assets over time. not sometimes, not usually, every time. Every single fiat currency that has ever existed has eventually returned to its intrinsic value, which is the cost of the paper it was printed on. And throughout every one of those transitions, the people who held physical silver and physical gold outside the banking system, not paper promises, not ETF shares, not futures contracts, but physical metal in their possession, were the people who came through on the other side with their wealth intact. The dip you are seeing right now in silver is not the market deciding that the structural deficit has been resolved. The mines did not suddenly discover a new continent of silver. China did not repeal its export restrictions. The LBMA did not find 3.7 billion ounces of unaccounted physical silver in a vault somewhere. The Federal Reserve did not reduce the money supply or balance the budget. None of the structural factors that drove silver from $29 to $83 in 12 months have changed. What changed is that 3 margin hikes in 3 weeks flushed out leveraged longs that a CME outage conveniently froze the market at a critical breakthrough moment, and that the institutional short sellers, the same institutions who paid over $1 billion in regulatory settlements for manipulation, bought themselves time. The dip is manufactured breathing room in a market that is structurally out of breath. And the people who use that breathing room to acquire physical silver, real allocated in their possession outside the banking system, are positioning themselves on the right side of a transition that has been building for 50 years, since the day Nixon closed the gold window in 1971 and the last link between the dollar and anything real was severed. The question is not whether you believe the silver market is broken. The evidence is documented, verified, published by the exchanges themselves, confirmed by the regulatory bodies, acknowledged by the institutions that run the system. The question is what you choose to do with that knowledge. Every delivery stress event at Comex and LBMA, every margin hike in the night when nobody is watching, every cooling system failure at precisely the moment silver is about to break out, every LBMA letter to its regulator admitting that transparency would break the market, these are not background noise. They are the system telling you over and over and in increasingly urgent terms that the gap between the price they show you and the value of what you actually hold in your hand is growing, not shrinking. The dip is a gift to those who understand what February 27 represents. It is a trap for everyone who sees a pullback from $83 to $73 and decides that means silver is going back to $29. It is not. The deficits are real. The industrial demand is permanent. The paper market is structurally exhausted. The monetary transition is underway. Own the metal, hold it yourself, keep it outside the system, because the system is the risk